Welcome to Your Money, Your Call. It's the bonds versus equities. I'm Mark Todd from FIIG Securities, and if you have any questions on the share or the bond market, please feel free to pick up the phone, 1300 30 34 35. The email is yourmoney@skynews.com.au. Joining me tonight on the show is John Pearce, who is the Chief Investment Officer for UniSuper, and Chris Alcott, who is an Executive Director at Mason Stevens. They're here to answer any of your questions, and hopefully we'll have some water soon, because we're all cooked. How's business?
Good. You know what it's like, Mark. Very strong correlation between happiness and returns.
Yep.
So returns are up, happiness is
Everyone's
up.
happy.
Absolutely.
Happy wife, happy life. I don't know how I can get happy wife, happy returns, happy members, I suppose. All the members will be pleased.
Very pleased.
What's the feedback? How do you get feedback? Do you get it like your members? Well, let's actually talk about first UniSuper. It's how big is it now?
We're about 40 billion, and our constituency is the higher education workforce in Australia, so it's an educated workforce, so we have plenty of feedback, plenty of suggestions, plenty of advice. Absolutely. So, obviously we've got a contact centre like everyone else, and so we're no shortage of feedback.
At the moment, it's pretty positive?
Very positive. As a matter of fact, we're seeing a very steady move from defensive assets to growth assets. Not big amounts, but it's definitely a very steady trend, and I think it's a combination of confidence in the market, but also I'm sure people are rolling over term deposits, etc., at 3%, and they're not happy with it, and they're just going up the risk curve. Yeah,
that makes sense. How's business for you, Chris?
Good. Busy.
So tell me a little bit about Mason Stevens. I know, but can you just tell the viewers a little bit about your business model?
Well, our business model is a multi-asset, multi-currency investment infrastructure or platform, if you like, and we enable people to purchase and transact in equities, fixed income, currencies, and we administer that all on an infrastructure that we've...
So in the same way you have a BT wrap, you can have a Mason Stevens...
Similar type of setup, yeah.
And do clients, how do they access you? Is it through... do we log on, do we look for you on Google and do it that way, or is it through the planning arrangements?
Predominantly through the planning network. So we have a number of planners that support us and like what we're doing. So we have built some products which some of the planners use, and also we facilitate the planners and how they'd like to invest their money on behalf of their clients.
Are you seeing the same sort of trends as John's talking about in terms of the term deposit market? And I guess everyone likes to bash the banks because it's good sport, but to some extent you can understand credit is very hard to grow, and everyone doesn't quite understand how Basel III plays out, but it's challenging. So there's, I was talking to the term deposit people today that the banks are reluctant to bid for any money. They don't want money. Is that what you're seeing with your client base? People saying, look, term deposits are at 3 and a little bit.
Yeah, we are. I mean, to John's point before. Certainly the chase for yield still exists, and that's why we've seen some growth assets, or some equities at least, continue to rally over the course of the last 12-18 months or so. But also the opportunity cost of a lower term deposit means that you can start chasing things like growth assets, and people are now prepared to give up a little bit of yield, and they're going up that risk curve to try and get some growth.
Are they going, when we talk about the risk curve, and I'll show a chart later on, if we go to term deposits, we go right down to equities, or are they going to something else? Are they going into the fixed income piece and saying 6%? Is that, in terms of your clients?
A bit of both. Look, we've got an income
option, and that's been very popular, so that's actually not having a bit of an each way bet. They're not prepared to go all out growth. They really want the high yielding assets, but of course that's been a big performer as well, because they've been that's been the popular asset class.
So what would you put, broadly speaking, in an Aussie income growth? Is it
dominated very much by the banks, Telstra, Woolies, etc. But we're striving for a dividend yield, gross yield, significantly higher than the average yield of the ASX 300, and it's pretty easy to get with those sort of stocks.
When you set that parameter, it feeds into itself to some extent, doesn't it? This is my parameter. I want these dividends, and then you can just look at them and say, well, they make sense. That they
but you've got to be careful, right?
If you go down to the bottom range, really high dividend,
That's right. It's not just a matter of just looking at the dividend, dividing it by the share price. We want to see sustainability of the dividends, and growing dividends. And look, there's a couple of real traps there. Just looking at a pure dividend yield, and we're not falling into that trap.
When you hear the idea that APRA and various commentary coming from the bank saying, be careful, you're paying out too much in dividends, special dividends to the banks. How do you think the banks will be thinking about that?
Well, we know how Westpac thought about it. They gave a special dividend about 2 days after that was announced. Look, well, there was nothing official from APRA to the banks, all right, because otherwise the banks would have had to disclose it.
Yep.
And, you know, we've met with all the bank CFOs post their latest results. They are in great shape, all right? They've got plenty of capital, and just organic growth is going to get them over the line in terms of future requirements for capital. So, you know, the yield story is still very strong with the banks, but you know, I think viewers should not be under any illusion. You know, banks are a leveraged play on the economy, right? So if the economy turns south, you know, the banks will also. Yeah, that's right. You know, they won't get the tailwind from you know, improving credit cycle.
So, Chris, you're keen on those banks, but providing some option coverage. Do you want to talk to the viewers about the sort of the trades that you see with the option market?
Well, I think the banks are great businesses. They're an oligopoly domestically. They've had a long, consistent history of rewarding shareholders. But price always has to be a consideration when you're looking at buying into that sector, and particularly given they do run highly leveraged balance sheets and they have exposure to the economy. So we look to say long term, you know, these are great companies to own. But when the price gets maybe a little bit full, you can do things like buy and write strategies, which is sell call options at a price higher than the current price, and try and add to your return and maybe reduce your volatility.
So an $80 December call for CBA, you might pick up $1 or whatever it is, and CBA's at $77, and you think, oh well, if it gets to $80, I'll happily sell, and at the same time I get $1.
Yeah. Look, it's been a good trade until it's not, right? And you've seen a lot of these fund managers that have you know, been successful with that trade for a long time, but last year they haven't been. Okay, it really hurt because they kept on losing their stock.
And when they lose their stock, John, are they benchmark against the performance, so they have to then chase it, don't they? That sort of gets it going again. Is that?
Yeah, look, that can happen, right? And you saw, you know, some of these fund managers that have traded, their absolute performance has still been very solid, right? Because the market's up. But relative to the others that haven't pursued the buy-right strategy, their performance has actually been quite poor.
And there's always this commentary around alpha. You know, you're over-trading because you're coming up with too many strategies where you could have just bought CBA at $58 and just sat and took the dividend and moved on. I suppose my next question for you is, you know, your strategies sound good. The fastest growing sector I talk about all the time on the TV is the SMSF. So how do you cater for those customers in terms of the academics who want to do it themselves? Is there something that UniSuper now offers to them?
No, we don't. We know there's a trend for others to do it. I think we've got to be realistic in terms of who we're going to service. All right, and you know, there are other providers that are better equipped to look after that sort of clientele. You know, we're setting up the fund. We want to make it cost efficient for the vast bulk of our members. There are going to be some members that at the higher end that want more customised strategies, etc. We shouldn't try and be everything to all people.
Yeah, right. And so you think those people that might be doing it are probably just trying to create a new segment, because they seem to be quite worried about it as opposed to what you're doing, which is around performance.
That's right.
You know, you've seen. You know, I remember you telling me if the people who had got out did not get out and stayed with it, they would have got their money back and some. And it's interesting to see that people find it very hard to rise above the noise, don't they? It's about that volatility, that panic-based volatility.
I've spoken to a few members that have got some in super in the UniSuper, and they took some of their self-managed, and they wish they didn't go to self-managed now. Well,
I suppose, Chris, you must have people coming into you looking to get your advice in terms of good strategies, bad strategies, as much as you can offer it. There must be an element in you that says you were always a pharmacist and now you're an investor. And at 60, it's hard to become an investor. Do you find that that's a conversation you're having with a lot of people, trying to educate them?
Well, yes, sometimes, yes, certainly. I mean, basically, the other thing that I think we find challenging is that investor behaviour can change so quickly, and investors tend to have a fairly short memory. So while it's been pretty good for the last 12 months, and long may it continue, the expectation is that will continue into the future, because the lows of the GFC and other things and the feelings at those points in time are largely forgotten. Well,
after the break, we'll talk about how Ms. Yellen won't be affecting that. So we'll have to go there for a very quick break. We'll be back soon.
Thank you.
This is Jennifer Chen. She's a mum who loves buying toddlers' clothes at wootsycutesy.com. Right about now, you're probably thinking, why would Jennifer be buying a quad bike called the Swamp Pig? ANZ's thinking the same thing. That's because we've got ANZ Falcon Fraud Monitoring. It can sense when a purchase doesn't look right, so you're protected. How purchase? By credit or debit card. ANZ Card Security.
Look, every day we're using more and more energy.
The world needs more energy.
Where's it going to come from?
That's why right here in Australia, Chevron is building one of the biggest natural gas projects in the world. Enough power for a city the size of Singapore for 50 years.
What's it going to do to the planet?
Natural gas is the cleanest conventional fuel there is.
We've got to be smart about this.
It's a smart way to go.
TPG presents our Unlimited Bundle. Get unlimited ADSL2 Plus with home phone line rental. Unlimited calls to local and standard national numbers. Unlimited calls to Australian mobile numbers. And unlimited calls to selected international countries. Plus a Wi-Fi modem. All for just $79.99 a month. Yep, $79.99 a month. TPG is a multi-award winner.
tpg.com.au.
If you're 30 or over, you're guaranteed to save when you switch your comprehensive car insurance to Coles Car Insurance. So make the move today and save with Coles Middle Rate One.
On Friday Live, Kevin Rudd's last week in federal parliament, his career and his options, and the Abbott coalition government. How is it settling into federal parliament? Also, Yoko Ono's in town, and we're still talking about whether he broke up the Beatles. Friday Live, Sky News.
Welcome back to Your Money, Your Call, the Friday edition. It's Bonds versus Equities. I'm Mark Todd from FIIG Securities, and joining me tonight is John Pearce, the Chief Investment Officer at UniSuper, and Chris Orcott, who is an Executive Director at Mason Stevens. And they're here to answer any of your questions. Feel free to give us a call, 1300 30 34 35. The email, yourmoney@skynews.com.au. Chris, I suppose you service a lot of the planners. You were saying you get a lot of...
Sam, because I get the impression that the planner space is, due to the change in regulations, a tough place to be. I mean, what trends are you seeing with those guys?
Well, I think they're facing similar challenges to their clients in that they've got lower term deposit rates. As, you know, in the last few years, they would have had clients that are probably a little bit more nervous. They've seen markets starting to trend upwards and, in some cases, aggressively. And off the back of that, they've had the regulation imposed on of FOFA, Future of Financial Advice.
So, do you want to talk to the customers just briefly in terms of the FOFA? What are the top 2 or 3 points that it's looking to try and achieve? It's around fees, it's around advice. Is that the major?
Well, it's meant to be a response to what happened to some people during the GFC, where they may have used margin lending aggressively and may have paid fees on the gross value of those, or potentially fees weren't disclosed. And you know, I think whether the response has been appropriate or not, I think history will tell us. But certainly it's been an additional challenge that the planning community has had to face. And luckily, the planners we deal with have been ready for it. They've added value, in my view, continue to add value to their clients with the strategies they implement. So
yeah, right. John, we've got yield growth. I mean, what do we do? If you're not that you're going to advise people here directly, but in terms of a macro strategy, what do you think is the 2014?
Well, let me. I, for one, do not think that the yield trade is dead. You know, we hear a lot of the sell-side analysts talking about overvalued yield, etc. You've got to be a little bit cynical there, because sell-side analysts like to turn their portfolio, etc. You know, the yield trade to me is not dead until we have the end of this so-called era of financial repression. You know, until the central banks start tightening rates, etc. Now, you know, the US is a long way from that. Europe is still going down. The Japanese have really just started.
So the yield trade to me is far from dead. So, but I come back to my previous comment. It's not just straightforward yield. We've got to look for, you know, growth, growing dividends, sustainability of dividends, etc. That's what we're attracted to.
And to your point, when they talk about the forward guidance, how do you feel about that? Do you feel comfort in that they'll get that right? Because that's the yield trade. Interest rates will be low for a long time, 3 to 4 years or whatever, 2 to 3 years. There's been some dispute about that, hasn't it? The traders have tried to say, no, that's not true. But what's your thoughts on that?
Well, the key is inflation.
Yeah.
All right. If as long as inflation and inflationary expectations can stay subdued, we can have low interest rates for a long, long time. But as soon as inflation starts to rear its ugly head, all bets are off. People think about risk being risk of deflation, risk of recession. Recessions don't actually kill financial assets as much as inflation does. So that's what we need to be really.
What are your thoughts, Chris, on deflation? I mean, we hear talks in the States about deflation. Do you believe that that's a viable? Does that make sense? Do you think there's deflation?
Well, I think if you watch the Wesfarmers ads, prices are down. So we have seen deflation actually exist in our economy. So certainly when you look at a basket of goods and you get a weighted outcome, and certainly electricity, oil, those sorts of things, petrol have been much higher. But actually we've experienced deflation with consumer goods and also staples through the last little while. So there are pockets of the economy that have
compared to energy going up and property prices going up and wage growth, if Mr. Newman was right, that's obviously going through the roof. I've got to tell my boss that. Inflation, are you worried about inflation here in Australia?
Well, I don't think anyone's particularly worried about inflation at the moment, but that in itself could be a worry. Yeah. All right. The fact that everyone's quite sanguine about inflation.
As I said, inflation is death for financial assets. So no, I'm probably with the crowd at the moment a bit more worried about deflation than inflation.
In the States, you worried about deflation, or here?
Look, it all more in Europe. Japan still not out of that mire. The States probably gets by, but they've still got a lot of surplus capacity there. So there's still deflationary influences rather than inflationary. When
I think of the deflationary impact in the United States, I think of the energy costs being so cheap. I mean, there was some data this week that says that they will, by 2015, and a lot of these data, they get it wrong. They're just making a statement. But by 2015, they'll be independent in oil from Saudi. There'll be more oil than the Russians. 2015, they won't need to import oil. That's an amazing statement.
Amazing.
It's extraordinary. Yeah. And so the effect, when you think about deflation, you think about those lower energy costs, and they've still got so much capacity in the workforce that they have learnt that art of making people work longer for less. Yeah. And so that's the deflation that, you get what I mean? Like, it's not necessarily the assets are falling, but the inputs are falling.
That's right.
And it's interesting how they're not going to try and rush themselves out of that. So when you hear Yellen talking about getting back to the traditional growth, maybe it's going to be harder than she anticipates. Do you think?
Look, I agree. Look, a lot could depend on the emerging countries, though.
Yep.
And the fact that they could potentially export inflation. Historically, for the last decade or so, they've been exporting deflation with their currency.
Yeah.
Right? But if they open up capital accounts, etc., China's always going to have to try and keep a lid on inflation. Yep. Right? And if China could potentially be the growth engine for the world, and they could actually help inflate, which in a healthy sort of way.
Yep, right.
But that could also get a little bit out of control.
Yep. What's your thoughts on the States at the moment? Your clients.
Well, I think
get in there.
I think the market is very much focused on bad news sends markets higher, because they expect more money printing if that occurs. But more recently, the data's actually improved, and anecdotally, we're certainly hearing some very positive things out of the States. I take the point as well that China's got a much bigger role to play going forward, and I think if they can free up the currency or things like that going forward, and allow their currency to appreciate a bit against the US as an example, that would be good.
But Chris, when you're talking to your clients, how do they take advantage of the China story? I mean, is there a way to do that?
Well, there's a few different ways that you can do it. Firstly, you could buy shares in Hong Kong directly if you want to buy in equities, and there are a few of the large Chinese multinationals that banks and so forth that are listed in Hong Kong. It's difficult to get...
We're buying that in what currency?
You're buying that in Hong Kong dollars.
Yep, right.
So you have that risk that really you're getting exposure to US dollars and a quasi-exposure to that underlying company in China.
Okay, and is that the major one, or is there
There's other ways. I mean, the Chinese aluminium company, Chinese Construction, issued US dollar debt recently. So there's a way to get some exposure to those companies and earn very attractive yields in US dollars, while not necessarily going as far as buying a share.
Right, we'll talk to you about China in a second. We have another very short break. Feel free to give us a call, 1300 30 34 35. Email yourmoney@skynews.com.au. We'll be right back.
This isn't just a hospital, because it's much more than just wards, halls, smocks, scrubs and busy people. It's brilliant machines, reaching beyond these walls, connecting doctors to hardware, to software, anywhere, delivering better patient care wherever those patients are. Because a hospital isn't just in a hospital, it's everywhere.
This is Michael and Liz Adams, Shadforth clients. For over 8 years, Shadforth has helped realise their lifestyle and retirement aspirations. You too can become part of a real wealth story. Contact Shadforth for your free wealth ebook now.
Inspiration is everywhere. But sometimes you need to narrow your focus and let the colours tell their story. This is my colour story. Tell yours with Taubens Endure, the interior paint with a lifetime guarantee, plus NanoGuard's maximum protection and superior washability. Taubens Endure, engineered to endure.
At NAB, we lend more to Australian business than any other bank. Our competition, however, just dropped the ball. More give, less take.
On Viewpoint, how global warming is good for us. That's right, there's an upside for now, according to one international expert. He says we're heading for long-term problems and we need to solve them, but importantly, don't panic. Also, while all focus is on the old stages in federal parliament,
What fraud they are. Poison the budget. Absolute embarrassment. It is not good enough.
we'll have a couple of rising stars from either side go head-to-head over all the big issues. That's Viewpoint, live on Sky News.
Welcome back to the Friday edition of Your Money, Your Call. It's bonds versus equities, and my name's Mark Todd from FIIG Securities. And joining me tonight is John Pearce, who is the Chief Investment Officer at UniSuper, and Chris Alcott, who is an Executive Director at Mason Stevens. They're here to answer any of your questions. Feel free to pick up the phone and give us a call. China, we were talking about that. What's your thoughts on China in terms of investing into China or taking a benefit?
Look, we're not that keen on investing directly into China.
Yep.
China's notoriously a capital unfriendly place, and the major reason for that is because there's so much capital sloshing around China. So they, the factor pricing is never right, etc. A lot of government control over factor prices. However, you can't deny that there's a fantastic growth story there. So how do you play this? We've actually got an investment option called Global Companies in Asia, where we're buying companies in developed markets that are earning a growing revenue base from Asia and China in particular. So that to us is the best way to play the China story.
I was when I was in the States, I went to these private equity firms. I was working for one of those, and they get all their investors in and they get them to do presentations around what they're expecting and what they're doing and some investment thesis. And one of them was that idea about China. So this was about 2006. And they said, the question was, so how do I benefit? I hear what you're saying, what do I do? They said, buy BHP. That's the guy said. He's sitting in New York, said, buy BHP. Now, I don't know.
Yeah, the problem with BHP is because, it's a commodity, right? We much prefer companies that have actually got a much direct link to the end consumer.
Yeah.
All right, the big tech companies,
it's clearly got more sophisticated, but he was making the point that it was an app point. He was talking about it was the rule of law that BHP dealt in. It was the relationship BHP had developed, and you were then piggybacking off that rule of law and the environment you were in, and that that resonated with everyone in the room except for those who'd never heard of BHP. So that was the Americans. What about Japan?
Japan's really
how do you take
interesting.
advantage of
Yeah,
Japan?
look, Japan's. We were actually being structurally short Japan, but we've squared that up now because we can see. Look, this might be another false dawn. Japan's had a lot of false dawns over the last decade or so, right?
Yeah, absolutely.
But it's interesting. I heard this interesting thesis the other day. Whereas quantitative easing in the States has actually been a deflationary phenomenon because everyone's just using all this money to pay off debt. In Japan, they've actually run out of debt to repay.
Yeah, right.
All right. So the balance sheets are in such strong shape that now quantitative easing will have its desired effect because they'll use that money to expand. All right. So it will actually prove to be more inflationary.
So corporate Japan doesn't have debt. The government has massive amount of debt, but it's owned predominantly by the people.
That's right.
So the corporates reap the benefit of the fact that
it's in good shape. The banks are in very good shape. All right.
Yeah.
So Japan's basically ready to lever up again.
Yeah, right.
Now the question is, what's the catalyst for them to do that? And you've seen the Nikkei performing very strongly over the last 6 to 12 months, but it's been foreign buying.
Yeah, right.
All right. You know, you'd like to see the domestic, Japanese start to buy, before you get really keen. All right.
What's your thoughts on Japan?
Well, I think there's so many moving parts, and it's just a challenging place to invest. I mean, the yen moves around quite a lot. There was a school of thought some time ago that you would want to be long the yen versus the US dollar because of repatriation of treasuries, because of an ageing population. Now, that hasn't been the right side to be on. So I just think it's a pretty difficult environment, and given the cultural situation, the ownership of the government debt and so forth, it's just a very difficult place to invest.
We've had people on the show talk about trying to trade that JGB curve and just saying, it's
too hard.
It's just a death zone. You just lose so much money. I don't know how that happened. What about Europe? In terms of, what's your thoughts on that? Is that just a structural kick the can down the road and look after itself, or do you think there's some will around fixing Europe up?
Well, I think broadly, if you look at the UK first, obviously they've had some benefit of the program there. They actually wore some inflation for a period of time. Yeah. That's tempered. That economy's moving, that housing market's moving. And in
it's
Europe...
moving quite a lot.
Yeah.
The UK's really got a kick-ass theme, hasn't it?
It has. And there are economies in Europe that are going gangbusters. I mean, Germany is obviously the great benefactor.
So would you be saying to customers, sorry to interrupt, just on the UK, would you say to customers, buy the sterling, buy those guys?
I think we're a bit more comfortable investing directly in equities in that market. We've also got a relationship with Magellan where they run a separately managed account using our infrastructure, and they select those stocks in those currencies, and there are some European exposures.
We'll talk some more about Magellan after the break. We have to go for another very short break. Sorry for that one. But feel free to call us, 1300 30 34 35. The email, as you know, yourmoney@skynews.com.au.
Natural gas in all its forms is a clean, affordable source of energy that can fuel Australia's economy for decades. Australians recently voted for a government committed to new jobs and investment. Now is the time to secure 150,000 new jobs that the gas industry can create, and $40 billion a year in new exports. Natural gas is our natural advantage. With the right support, it can secure a brighter future for Australia. ournaturalaadvantage.com.au. Authorised by David Byers, APA Canberra.
This isn't just a classroom, because it's much more than papers, pens, desks and diagrams. This classroom is really in a classroom. This is science shared. The best teaching the brightest, using brilliant machines to empower local industry to compete on a global scale. Because our most valued resource isn't our technology or even the resource itself. It's our people.
Springdale. You could take the old road, 80 miles up Widowacres Peak, through the forest to the dam, and over Dead Man's Gap. Or you could take the new road.
Who makes the iX35 Series 2 an SUV that feels tough enough to handle anything? We do. Hyundai.
On Viewpoint, how global warming is good for us. That's right, there's an upside for now, according to one international expert. He says we're heading for long-term problems and we need to solve them, but importantly, don't panic. Also, while all the focus is on the old stages in federal parliament,
What frauds they are. Poison the budget. Absolute embarrassment. It is not good enough.
we'll have a couple of rising stars from either side go head-to-head over all the big issues. That's Viewpoint, live on Sky News.
Welcome back to the show. It's Your Money, Your Call. It's bonds versus equities, and we've had our first caller for the night. I didn't hear the name. Richard. Hello, Richard. How are you? How can we help you?
Very well, thanks. I have a question regarding, you mentioned before, investment opportunities in China. What's your view on the Chinese banks buying through Hong Kong, given that they are trading at approximate book value, and yet their return on equity is somewhere in the vicinity of 15 to 25%, depending on the banks, and their profits are still growing?
Right. Do you want to take that one, John?
Yeah, look, we're not providing advice, but
No,
personally,
we're not providing advice.
personally,
Please don't act on this. Go get some
I
advice.
wouldn't be investing in Chinese banks. First, I don't trust the book value, but then again, I don't trust the book value of European banks as well. So this is not just an anti-Chinese bank thing. Most importantly, though, Chinese banks are controlled by the Chinese government, so they are effectively an instrument of Chinese monetary policy. Unlike trading banks, commercial banks and other economies, they've got their own flexibility around how they price their assets and price their liabilities. Chinese banks are an instrument of monetary policy in China. All right, so you're actually buying Chinese monetary policy. I'd stay clear of that.
What about the local banks here, the Chinese banks down here? APRA regulated. They're much better opportunities if you want to buy into those assets. You get some good returns.
But you're buying debt, right? You're not buying equity.
Yeah, that's right. Oh, yeah,
okay.
Yeah.
Right.
So
Now, debt is a different story. All right, different story. I mean, I think the bank debt, is actually very safe because it's backed by the Chinese government.
That's right.
The Chinese government is one of the most solvent governments in the world.
Yeah.
Right? So
they own all the cash.
Exactly. So I cannot see the Chinese government ever letting one of those.
So Richard, in the bonds versus equities, well, we've just got bonds with a big tick. The equities.
Chinese bonds.
Chinese bonds.
Of banks.
Okay, we'll work on the Australian bonds in a second. Let's stay international. What's your thoughts on Europe? I didn't get a chance to talk to you about that.
Well, I'm a bear on Europe, Mark. Look, I know there's been a rally in European equities. I know there's some flickers of hope there, but people are expecting a recession.
0.1% growth and everyone's happy. Look, your history tells us you cannot have a strong economy with a weak banking system.
Yeah.
And the European banking system is weak.
Yeah.
All right? They're undercapitalised. A lot of the peripheral government debt is actually owned by the peripheral banks.
Yeah.
All right? So credit is actually not going to the people who need the credit. They're just using the excess liquidity to buy government bonds, etc. I'm quite bearish on the banking system and the European economy.
For the viewers at home, the ECB President Draghi will speak on Tuesday, and he'll talk about what they will need to do in terms of their QE and what steps they're prepared to take. And he was the one that was saying, "We'll do whatever it was take." It was like Churchill, and he didn't have to take any steps, did he? He didn't actually have to do anything. But there are going to be some stress tests on those banks in Europe, and you might have to actually stump up and do something, put some money to work. So there's some challenges at foot in Europe, just around Germany and the whole, who takes ownership of the European question, which is unification in a proper manner. Whether it be Euro bonds, whether it be tax systems, it's a very complex situation, and there's probably better opportunities to buy elsewhere.
Yeah, and look, to Chris's point, though, the UK is a different situation, right? It has its own currency.
Yeah.
The euro is the financial equivalent of Frankenstein's monster, all right? Whereas, we've got the sterling.
I mean, you look at the story in Spain. I mean, you look at some of the unemployment stories there. There'll be intergenerational unemployment. There'll be people who will never have a job, and their kids will never have a job, and it's just because there's so much excess capacity.
Look, I mean, no one knows how it's going to end, and it is a travesty. I mean, that's a horrific environment to grow up in, as you say. But I do think the smaller economies, I think probably if they did end up leaving, like Greece and Portugal, I think the world, certainly given the strength we've had of late in equity markets, might be a little bit more open to that type of thing, but the big problem is you've got very large economies like Spain and even France and Italy that their books, their balance sheet doesn't look too hot.
You know, the French got sold off. We were talking to Aberdeen and saying like the trade was sell the French, buy the Germans. But you've got to think the Germans would be a little bit more gracious. You know, they've reaped the benefit of that euro. They're punching out all those BMWs. Yeah. They should be happy. Like, put a smile on your dial, and no, they're still telling you how to do it.
Well, that's why the Germans will keep the Greeks in. All right.
They need it. They need
the Greeks in. They need the currency low. All right. Otherwise, they'll have a Deutschmark that's double the value of the euro.
You'll never get another BMW in Australia. Tell me about tapering. What's your thoughts on that? How do you see that? Because that's obviously the main game. I've waited till late to get the real one.
Well, I think extricating yourself from tapering is a huge problem, and we saw that a mini version of what that might look like through June in the correction that we had. If you look at even the talk of tapering, and not even a consistent view from the governors, you saw Bernanke start the process, and then markets just got sold off aggressively. The emerging markets got sold off aggressively. The US 10-year yield doubled within a space of 6 months or so.
Absolutely.
And the problem is that there's a number of problems of extricating yourself if the market is going to react like that. And even though you've got low interest rates, the market doesn't believe that, and they'll bid the curve higher. And if the Fed is facing a 10-year Treasury yield above 3%, then they're taking huge mark-to-market losses on whatever they've borrowed to print today, and they might find themselves back cup in hand with Treasury. So it's a very, very delicate situation they've created, and I'm not sure how it's going to end.
What about you?
Look, I agree. I might just point out to the viewers with tapering what we actually mean by tapering.
Yeah.
You know, the Fed's buying $85 billion a month of a combination of government securities and mortgage securities, and tapering is all just turning that 85 into 75 into 65, etc. That's different to US monetary policy, which is interest rate policy. So I think from an investor's point of view, if you can actually see through the volatility, it shouldn't be that big a concern. All right, we shouldn't get too scared by it, but the market reaction will be just as Chris said.
Well, that's the point we've been telling all our customers, that expect 2014 to be a volatile period because they have to try and taper. They have to try and start it. So
in the market who will look to take advantage of what they see as weakness, and they'll try and push the interest rates higher, and they'll try and make money. But that's what they're going to try and do. If that keeps you awake at night, then stay in cash, buy TDs. But if you can look through it and say, I think the policy guidance will win out in the end. It'll take some different levers to pull. The policy guidance will get them to where they want to be, so interest rates will stay low, then act in that accordingly, and just put it away and take the coupon. But if you look at interest rates in the United States, in the last year, the 30-year mortgage has gone from 3.4 to 4.5.
Yep.
And that's had a, they know that's a huge problem, don't they?
They do, because in the US, mortgages are actually priced off the bond yields, whereas in Australia it's more depending on the short-term rates, and the Reserve Bank has a lot more control because they've got control over monetary policy, short-term rates. The US, it's really tough because it's much harder to control that longer end of the curve.
And the thing it does is that mortgage book, if they aren't turning those mortgage books, you can see that yesterday, S&P and Moody's are coming out with reports on those regional US banks saying they're not turning over their mortgage books. There's no new clients coming through. So it means it just makes it harder to not get fees.
Well, the other thing is the Fed has dominated that market as well with their asset purchase program. They've dominated the mortgage-backed buying market, and that in itself is not necessarily a bad thing. And those at least will amortise over time, those mortgages. But also, I think the politics is a big issue when it comes to.
We'd love to go into politics. But John and Chris, what does that mean in terms of onshore-offshore investing? Do you think, bearing in mind what 2014 should look like, do you just stay onshore, or do you say, well, there's some good bargains there, go offshore? What's your thoughts?
Well, clearly, Australia's a very concentrated market, right? It's dominated by the banks, and I think the top 10 stocks is something like 70% of the market cap, etc. So there's a big diversity going offshore. We just don't have Microsofts and Apples, etc. here. But when you go offshore, you've got to basically say, well, I'm happy to get a lot of my return from capital growth, okay, because dividend yields are very low. And then you've got currency. Now, a lot of people are saying, look, the Aussie dollar is going back to this long-term average of 75, etc. So currency is actually currency risk is a good thing. So I'm going to make some money on that. Look. Yeah, look, there's some downward pressures on the Aussie dollar. We've got, obviously, terms of trade are falling. We've got lower interest rate differentials. The Reserve Bank wants it down. But on the other hand, we've got this massive reallocation of reserves from the trade surplus countries like China. Now, they're talking about de-Americanizing the world, moving more of their reserves into other currencies. A 1% move, when you've got trillions of dollars of reserves, a 1% move into the Aussie dollar is a huge support for the currency. Yeah. So, look, I think it might be wishful thinking in terms of this currency falling in a hurry, quite frankly.
The other thing is, Mark, I'll just add to that, is that if the Aussie dollar does fall, then it will naturally cause inflation, which means the RBA is got a real challenge to continue to leave interest rates at this level, if not cut them altogether. So if you continue to, as an import-driven economy, continue to import goods and see those prices rise, that's going to lead to inflation, and the RBA may have to do something about it. And certainly if you get an aggressive move from mid-90s to mid-70s, I think that's a genuine risk.
We will definitely be talking about the RBA because they are in such a bind. They are in such a weird world where it'd just be a world of pain trying to come to a conclusion. But we are going to have another very quick ad break because they have to pay for the show somehow. So we'll leave it there. We'll be straight back after this break from our sponsors.
This isn't just a hospital, because it's much more than just wards, halls, mocks, scrubs and busy people. Brilliant machines, reaching beyond these walls, connecting doctors to hardware, to software, anywhere, delivering better patient care wherever those patients are. Because a hospital isn't just in a hospital, it's everywhere.
If you're 30 or over, you're guaranteed to save when you switch your comprehensive car insurance to Coles Car Insurance. So make the move today and save with Coles.
In your lifetime, you may lose many things. But if you wear a partial, one thing you don't want to lose is any more teeth. Introducing new Polydent for Partials. To care for your partial and help protect your natural teeth, Clean and Protect kills odour-causing bacteria. And Seal and Protect helps minimise stress, which may damage supporting teeth, by stabilising your partial. Visit polydent-partials.com.au to learn more.
At NAB, we lend more to Australian business than any other bank. Our competition, however, just dropped the ball. More give, less take.
Are you the type of traveller who loves an exclusive airfare deal? Or an itinerary that's a little different? Get on board Flight Centre's great Red Label fares. You get unbeatable fares with the world's leading airlines. Lots of other extra value, plus the confidence of price drop protection. Find Red Label fares in-store, over the phone or online. You'll always be spoiled for choice, price and advice. That's the airfare experts for you.
Welcome back to the Bond
edition of Your Money, Your Call. I'm Mark Todd from FIIG Securities, and we're taking calls, and we have one right now. We have a call from Richard. Hello, Richard. How can we help you?
Hello, Mark. Look, I continually see on programs, reading this in review, and especially just a program now, this German bashing. I mean, maybe if the people around the world, sort of took the economic model the Germans have produced, it may be a better thing. I mean, we take in Australia, we have this fabulous negative gearing, allowing, a bank to be the biggest company in Australia, you know what I mean, and falsely inflating real estate prices. I mean, maybe you follow their model. Maybe a good thing. Bye.
We love the Germans. They can make the nice car. We're all thinking that's fantastic. But in terms of German bashing, I just think there's just so much material. But, they obviously do very well financially, and they're obviously the powerhouse for Europe, and they know it, and they act on it, and, good luck to them. Now, where were we before we were interrupted? Let's talk about, you were talking about offshore stuff. In terms of, if somebody wants to invest, what was the Magellan fund that you were talking about?
Magellan portfolio. So we run a managed account, a managed discretionary account. We administer the purchases, sales and collecting of dividends and so forth on a portfolio of shares. That is selected by Magellan. So you might have Google as an example. Magellan are a international fund manager. They have been around for almost a decade now, and they've had great success in their managed funds of managing international equities and produce very strong returns. They're listed on the stock exchange. Their stock price has had a good run, and they've been very well supported around the country through the planner network and individuals.
Do you have much to do with the Magellan guys?
Well, look, I know the guys there. They're very astute guys, and they'd be delighted. I've got some mates there. They'd be delighted with the advertisement they're getting here. Yeah, they're all very happy, wealthy Magellan shareholders as well. Look, they're very shrewd guys and quality managers.
We're going a little bit off track, but one of the things I've noticed, or themes I'm thinking about in terms of FOFA, the like, fees being charged for probably the wrong assets and the wrong sort of advice, and one of those things. One of the benefits of the GFC was that people that would have resided in organisations like banks, who were fantastic traders, are now out in the street in terms of in their own funds, because the banks can't take the risk, they don't have any leverage, all that sort of arrangement. Do you think that's a benefit to the broader investment community, people that watch the show, that they can actually now tap into people like Magellan? There's a whole array of them now, Roger Montgomery, people like that. Their performance is pretty fantastic. I mean, is that something that's good for you, for your business, being able to tap into those fund managers?
It's good for us, certainly, and you have the ability to assess these managers on their merits. You have the ability to look at what they do and challenge them on the decisions they've made. So you can understand, and if you buy a managed discretionary account through Mason Stevens, you can see every share that's bought in what currency, and you can track your individual circumstances. The flip side to what you were saying before is, I think we do need some risk. We do need, the entrepreneurial activity is very good, but within the banks, I think there's been probably a little bit too much focus on the systemic risk, and that possibly around the world have maybe gone a little bit too far in terms of stopping banks taking risk, because those institutions do need to take risk to enhance the growth of the underlying world economy. So
I think that game's shown they ain't going to take risks.
I don't think they are, but I'm just saying.
Well, we're going to see the consequences when this bond market really starts to sell off, all right, and your natural buyers and warehouses of bonds are not there anymore, right? So who do you sell them to? The banks aren't going to hold inventory on their balance sheet.
That's right.
You're going to see a chaos in the bond market.
I read a terrific article on Reuters this week saying exactly the same thing. The interbank dealers, the people that would have always gone to banks and trade, just can't do it. They don't have any balance sheet, and ultimately there's less liquidity because there's so many people having to buy and hold and stay on these things, and that's a real challenge. What about at Uni Super in terms of fund managers? You mainly do it in-house, or is it at 50-50?
We do about 40% of in-house, and look, we will always have a hybrid model because there are great fund managers out there that are going to always add value, and we, we understand our own limitations. There are some global strategies, there's some strategies, etc., that there are going to be managers out there that are going to be better than us. So there's always going to be place for good quality managers that can add value.
And how do they get to you in terms of, like, how do you work out, because all these people here would be looking for fund managers as well, so what is it? Is it people that you've got comfort with over time, or people like Airlie Fund Management, John Seville. I mean, fantastic.
It's too late to get from John, right? He's already closed, right?
But he comes out. He's a quality guy. He comes out of. He's on the show in a couple of weeks. He comes out of Perpetual. He's got that track record, and bang, people trust him, so they go for it. But other than that, how do new people come to Super?
And I'm not looking for a pitch from any fund manager, please.
Look, that mantra, you cannot, historical returns are no predictor of the future, right? We know that. But the reality is, if someone's done a good job over a decade, through a few cycles, well, there's probably a good chance they're going to keep doing a good job, right? So I think that's not a bad starting point, quite frankly.
And the idea that somebody says, last year I did 40%, you say, well, okay, that's 1 year, that's year one, that we're not going to go there, because a lot of people have chased that person at 40% thinking they're going to do it again, like Paulson, like those guys that did really well at the GFC, and then their performance has been terrible since. It's been quite a challenge to understand. Everyone followed the headline number the previous year. That's the risk, isn't it? Just getting the information right and trying to work out what's the best fund manager for you. Or of course you can deal directly. We can talk about that soon. It's time for another very short break. We'll be right back in just a moment. More words from our sponsor.
This isn't just a classroom, because it's much more than papers, pens, desks and diagrams. This classroom is really in a classroom. This is science shared. The best teaching the brightest, using brilliant machines to empower local industry to compete on a global scale. Because our most valued resource isn't our technology or even the resource itself. It's our people.
If you're 30 or over, you're guaranteed to save when you switch your comprehensive car insurance to Coles Car Insurance. So make the move today and save with Coles
Get more big brand toys and pay less at the Target Christmas toy sale with 20% off all Lego toys. Yes, 20% off Lego.
Get more at Target.
Give more, pay less at Target.
Perfect for both home and away. Massport barbecues have some fantastic exclusive features and are surprisingly affordable. Barbecue like a chef at home. Perfect pizzas, brekkie, kebabs, rotisseries, roast veggies, poached fish and more. And when you're away, the Massport portable barbecue is perfect for beach, camping or boat. Purchase any Massport 210 series barbecue and get a Massport portable for just $49. That's right, $49. Visit massport.com.au now and find out why it's not just a barbecue, it's a Massport.
A lot of banks try to seduce you with an introductory home loan rate. But NAB, we say if it looks too good to be true, it probably is. Is it packed full of fees? Does your bank charge you for reducing the length of your variable loan? Will they stop you setting up a 100% offset account to reduce interest? At NAB, we're proud that for 4 years, no other major bank has offered a lower standard variable rate. Talk to your NAB banker or broker about a good, honest home loan.
Welcome back to the show. I'm Mark Todd from FIIG Securities, and joining me for the last segment of the night is John Pearce, Chief Investment Officer at UniSuper, and Chris Alcott, who is an Executive Director at Mason Stevens. I just want to talk to you about, I didn't get a chance to do it before, but I want to talk to you about the Mason Stevens Credit Fund. Can you tell me a little bit about it? Obviously it's complex in terms of, there's all different assets you want to buy in it. But, at a macro level, what is it looking to achieve and what do you put in it?
Okay, it's a managed fund that we've launched, which has a PDS, and that's how you invest through it. And it invests in fixed income. And it looks to achieve a return of 3.5% above the cash rate after fees. It has...
What are the fees?
The fees are basically
0.6% as a management fee, and there's a buy-sell spread and those sort of things, but less than 1% basically is the total cost. And it's going very well. It was launched at the start of June, just before the markets turned upside down and the curve steepened aggressively. Managed very well. The unit price is up in line with that, actually exceeding expectations, and the current yield is around 6.5%.
I think you've got a slide here, Karen. Can we have a look at the slide, the performance of that fund, if that's possible? There you go. So the fund is, how do I read that, mate? 1 month, 3 months, 1 year? So it hasn't been going for 1 year?
It hasn't been going for 1 year, so that's NA. But for 3 months, as you can see there, we went through. It was launched at the end of May or start of June, and it's performed at plus 2% over that period. So on an annualised basis, closer to 8, and the running yield is around that 6.5%. So it's well exceeded its benchmark through what was originally a pretty challenging period of time to launch a fund, and it's done particularly well.
And you buy. In this fund, do you buy US dollar, different currency assets, and then what do you do? Do you bring it back and get the hedge back into Aussie?
Yeah, so it has the ability to hedge out the currency risk within the portfolio. So, to take an example, the Chinese aluminium company last week, or 2 weeks ago, issued an investment-grade bond at 6.7% yield. and when you take out the effect of the currency, you're getting closer to 8.5 in Aussie dollars.
Right.
So that's not a big part of the portfolio, but of the fund. But that's the sort of thing that they're able to do inside it.
And people put money into that. This is another ad for non-Magellan. This one is for you. But people put money in via planners, do they, or are they on websites, or what do you do?
Through planners, you can access it through our website. It's a retail PDS, so you can invest in it directly. Majority is through our planner network, definitely.
Yeah, right.
It's a minimum $25,000, and anyone can buy it.
Great. Well, I'm not saying that that's the best.
Take the time to read it, and maybe it might suit somebody else. Mate, IPOs are coming left, right, and centre. I mean, what's your? I'm naturally cynical because I think they're coming from private equity, and therefore they're not going to be trying to make me rich. They're already rich themselves. They want to be richer. So what do you think? How's that? Without talking specifics, how's that feel? Does it feel?
Yeah, look, you're right. The investment bankers that I speak to, they haven't seen such a strong pipeline for a very long time. All right, so these IPOs will come out.
Just to interrupt, did you see the guy at UBS? He said, I haven't seen this since 2006. And I thought, why? That was just before.
That's right. Yeah. Well, look, I think people have wisened up that, right? If you're buying from private equity and private equity are getting out completely and they have not got any more skin in the game, I'd be extremely wary.
Yeah, right.
Yeah.
Is that with National 9 with 9 Network? They're not getting out though, are they? Are they staying in, those guys?
Look, they've got skin in the game. It's not the sort of stock that we would look at, only because it's a different sector that we're looking at. Companies with much more stronger balance sheets, sort of the yield plays, etc., not so leveraged economy. It's not degrading. It's just it's not that. So it might suit others, but
what do you call it? Like snap, get your core question. Because obviously, it might suit some people. Everyone's going to buy these things. They think they've got a clearance rate. That's why they're doing it. It's not like they're testing the water. They know they're going to get out with it. It's just that if you're going to buy that, you need to have something that's more conservative to counterbalance that, because you're looking to get a 7% return for a $40 billion fund. I mean, to the viewers at home, 7% is a pretty good number, don't you think?
Look, well, we've got different options, all right, and obviously we've got a high growth option that will target more than 7. But for our core balanced options, etc., and for the average superannuant, 7% returns for long term is pretty good. Right? Inflation plus 4 or 5%.
Yeah.
If you did that over a long time, you'd be a pretty rich person.
And one of the things is that you see a lot of the press are driving this. The bank index has gone up 20%, and you feel bad if you only made 7%. You feel like you've missed out on something. And that's sort of missing the main game. The main game is being able to stay in there and.
Is that what you're telling your guys? Just 7% is a nice number. That's the target.
Oh, look, it comes back to the point of different investors value different things, in a very different way. And risk is one of those things that is, while there's lots of books telling you what risk is, people's view of what risk is very different across the market. So I think you've got to understand the risk before you assess whether 7% is a good return.
And for the viewers at home, the first thing you have to understand is, can you take the volatility? Are you aware of the risk? And will you stay up at night? And if you stay up at night, don't do it. Buy TDs. That's all we have time for today. Thank you so much. And to our guests, we have John Pearce, Chief Investment Officer at Uni Super, and Chris Alcott, who is an Executive Director at Mason Stevens. To all the viewers and the phone calls, thank you very much. Until next time, I'm Mark Todd from FIIG Securities. Have a great Friday night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements